Welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmgren, and next to me is my colleague Niklas Sävås. How are you doing today?
We're approaching earnings season now, and it's a really interesting time of the year, so I'm excited.
Great. And today comes another conversation run by one of our friends at Investing by the Books website, Christian Billinger. Who is he?
Christian has a long career as an investor and currently manages his own family money in the investment company Billinger Förvaltning, where he focuses on finding stable long-term compounders. He is a member of MOI Global, which I am as well, and I highly recommend everybody to check out MOI Global. They have, great featured investors such as Howard Marks, Tom Gaynor, and Guy Spear, and Christian is featured among them.
Yeah, we'll put his interview there in the show notes for sure. And who is the guest that Christian has talked with?
So on the other line is Professor Lawrence A. Cunningham, who is one of the most prominent authors of investing books, and especially focused on Berkshire Hathaway and Warren Buffett. We discussed one of his books, The Essays of Warren Buffett, in episode 7. And besides writing, he's a professor at the George Washington University, a columnist for MarketWatch, a trustee of the Museum of American Finance, and also vice chairman of the fantastic vertical software conglomerate Constellation Software in Canada.
Yeah, and what is the topic for today's conversation?
The starting point is Cunningham's book Quality Investing, Owning the Best Companies for the Long Term, which was published in 2015. He wrote it together with the UK investment fund AKO Capital's portfolio managers Torkel Eide and Patrick Hargreaves, and the book describes the philosophy behind the school of quality investing. The authors lay out a great toolbox and go through a few do's and don'ts. Also, they provide a lot of case studies of great businesses and how these fit the different patterns described.
Quality Investing is definitely a favorite book of mine, and I believe the approach can be very profitable, and quality businesses is something that we look at a lot at Redeye, and in our premium offering, our topics portfolio, we have many of those. And I think if you know how to identify quality companies and what enables them to outperform over time, you can be a very successful investor. So that and much more in today's special episode, where Christian Billinger talks with Professor Lawrence Cunningham.
So thank you so much for taking the time to speak today. And I guess to most people, including myself, you're certainly sort of best known for all the work you've done on Berkshire and I guess more recently on the Quality Shareholder Initiative. But I wanted to discuss this book, Quality Investing, because I think it's such a wonderful book, and it's certainly, it's been very meaningful to myself, and I know it's had a very sort of it was received very well in certain sort of investor communities. So I know Dan Loeb, for instance, he says it's mandatory reading at Third Point, and so I just love the book, and it's just such a great toolbox, I find, in terms of how to identify these companies and things to sort of look out for, etc. So I guess the first question I wanted to ask you is really, the book came out about 5 years ago, I think, in the UK. Do you feel that the sort of conclusions in there, etc., are equally valid today, or are there things you would change or amendments you would make? So, for instance, I guess the shareholder structure conversation, perhaps, I know you've spent a lot of time on that recently, is one that isn't quite as sort of, doesn't take up as much space here. So are there things you'd amend in there?
Well, I do think it has withstood the test of time overall, 5 years on, and I think it was in some ways a traditional or conventional analytical approach to investing that I think has a lot of antecedents, a lot of predecessors. So it's I think in that sense it draws on a classical tradition. So I think it will have legs for many years to come.
Yeah.
But like anything, it's not complete and it's not perfect. And I think if we were to rewrite it today or write a second edition, we would probably emphasize some additional discoveries or points of emphasis. I doubt we diminish anything. I don't think there's anything there that was that turned out that in terms of analytics and approaches or screens or patterns. I think the substantive content there remains durable. There may have been a couple companies they've changed a lot. One of them merged out of existence. Another one struggled in different ways. Some of them didn't perform perfectly fine, but maybe not as strongly as you might have expected. But for the most part, the case studies are remain instructive. So, but I think I'd add, to your point about share structure, I might want to just explore a little bit more the issues around what is the significance of who the other shareholders are, what kind of powers and rights they have. How do you think about dual class structure and things like that? So I'd like I'd like another crack at a book like that, and and could add emphasis in some areas that I think they've always been important, but for one another reason we didn't dig too broadly into them, but some of the intangible features of corporate life, and but we wanted to keep it relatively compact and relatively accessible and easier to read, so we kept it under a couple hundred pages. So I don't think sitting here today I feel like if it was me 5 years ago I'd have done all that much different, but today I'd like to add to it or continue to develop the themes.
And do you feel there's a risk in that perhaps there's now too many sort of investors chasing quality businesses? It just seems like in the last sort of 3 or 5 or 7 years, there's been this is anecdotal, but I guess it seems to me that more and more sort of high profile investors are speaking in those terms. I look at people like, Howard Marks, I think, was the most recent example. I get the sense that he's, in one of his most recent memos, he's sort of saying, valuation discipline isn't quite what it used to be. I'm more interested in the quality of the business now. And I think people like Manish Pabrai have said similar things. Do you feel there's a risk there, or does that sort of invalidate the opportunities in the quality sort of arena in any way?
It's an excellent question, and I admire Howard and Manish very, very greatly. Incidentally, Howard lives right down the street from me, where we are.
All right.
Slightly fancier house, but he came out here during the pandemic too.
Fabulous. Those are nice neighbors to have. I'm sure you'd have a lot of interesting conversations about these sorts of things.
Yeah, I talked to Howard. I also talked to his son Andrew, who's also super intelligent. But I think the point they're both making, you're making, is fair, and and I guess I'd have two observations. One is that it remains what that cohort of investors do, even if they're all doing a similar thing, even if they're all hunting for quality and driving up premiums. Even so, they're adding enormous value to probably their own clients, their own wealth, and society, because they remain the vehicle that allocates abundant wealth, abundant resources, and it's compare that to the index funds, which they don't do anything, really. They just have automatic purchase and sales based on what everybody else has decided, and so they command abundant capital, maybe 30% of total U.S. equity at least. But it's Howard and Monish and you and others, who are actually doing the homework and determining, how much IBM or Tesla, is worth, and that then enters into the entire economic system. So, the second point I'd make, yeah, and even within that, and then there are also obviously a lot of transient traders, whether they're doing, computerized nanosecond trading or doing the court sort of craze of the day on this meme stock or that name or this even crypto stuff. So, and to me, that cohort isn't really adding significant value to the economic system. So, the likes of Howard and Monish, in some ways become even more important in that environment. But the second, so that's, for one thing, I think even if they were all doing the same thing, they still had a lot of value. But you're right. The second point, the problem, if they're all doing the same thing, then no one's going to get any particular opportunities. Functionally arbitraging away the discovery of the payoff from a long-term, maybe it's a growth-oriented kind of approach, or a quality approach. And to me, what that means is, this goes back to your first question. Are there any topics that I left out of quality investing? That's where the money is. Well, what else helps a company outperform? What levers are we missing? And the two that I've been very excited about in the past couple of years are, one, who the other shareholders are, and if they've got a high density of Howard and Monish and Brian compared to the indexers or the transients. The data I've been discovering is that's a signal of outperformance, of outperformance. So, hunting for those, the new, just undiscovered or underappreciated features of excellence or success. And so I think the quality of the shareholder base could be a profitable hunting ground. I think also the intangible features of the stuff that Reed Hastings has written about Netflix, or that we touch on in quality investing, is the Jim Collins type of thing about how things are done here. What's the culture? That's the idea. I've been involved in a lot of research around corporate culture. It's a nebulous thing, and a lot of investors don't like it because it's hard to measure. It's subjective and so on. But I think there is real money there, and I'd say, if the cohort have arbitraged away the basic toolbox of the quality investing book, I'd say investigate the quality of the shareholder base, the internal culture of the firm, and additional screens or tools in the kit to probe durable outperformance.
Yeah, no, that's yeah. I mean, it sounds like you're saying even if you're a quality focused investor, you need to sort of continue. You need to sort of develop and evolve, and I guess one of the challenges I hear to the idea of quality investing is some people saying, fine, quality companies may outperform over time, but aren't you just asking yourself an equally difficult question, which is, how do you, before the event, how do you identify those companies? And I guess increasingly some people say that's difficult because you've sort of shorter lifespans, you've increased disruption, whatever that means. I mean, do you agree with sort of sentiment that quality, it may sort of work buying quality companies, but it's it's still very difficult to identify them beforehand? Or do you think there are reliable ways of sort of pointing out these are quality businesses, in advance, if you will?
Well, I think what we try to lay out in quality investing was a framework of pattern recognition, basically, that says it takes up the old idea of competitive advantage.
Yeah.
And what Warren Buffett calls a moat, that some mechanism that makes it a little harder for the business to be disrupted either from technological onslaught or rivalrous invasion. And the question is, what are those competitive advantages? And everyone is familiar with a whole category of them, whether it's brand strength, or economies of scale, network effects, purchasing power, pricing power, rational rivals, and then we tried to delineate a number of additional, we call them the additional moats or features that help a company sustain its advantage for against onslaughts. So what we try to do, we delineated the long list, and everyone, there's abundant literature obviously on moats, but we then tried to look at patterns where combinations of these competitive advantages seem to become, if not impenetrable, then a mighty fortress that just makes it extraordinarily likely that a business will endure.
And is that sort of, do you feel that it's harder to apply those principles or tools? I mean, in a very general sense, a lot of investors keep talking, or increasingly, I guess, talk about sort of shorter lifespans and increased disruption, etc. Do you think that's made it harder to identify these quality companies, or is there still a sort of segment of the market where you can find them and where they still have these sort of very long-term competitive advantages?
Yes, I think I think it's always been harder to reach definitive judgments than it is to recognize the features or the tools, because of the competitive world in which we live, where forces are always driving change, whether from technology and surprising sources, from surprising places that could disrupt a business, like the internet and newspapers. There was no plan on anybody's part to kill small town newspapers, but it happened. And there's, obviously rivals are endlessly trying to grab share or at least expand their own business. And so being watchful of that problem is, as an investor, you got to watch these moats. And I guess, the insight that I've been studying a lot lately is that it's more important to know. It's fine to know how thick a moat is, or Mark Mobasins can offer some ways to measure. What's probably more important is the direction. Whether it's like teeth, or like your gums, are they getting stronger, or are they getting weaker? And that's something you can, if Mark's right that you can measure it a bit, then you can see it changing. And it's the combination, right? It's not economies of scale, period, or geographic reach, period, or brand power, period. It's all of them in combination. And then, if you can determine that the business is reinvesting in that moat in multiple directions, so that it's growing and strengthening its position, that enables a safer prediction of durable competitive advantage. Whereas if it's shrinking, or if it's gotten pocked, it's gotten hit in a couple of spots, even if it's still strong, that's not a good direction. So
I guess that sort of, I guess we've heard Buffett referring to this so many times that, all he wants his sort of managers to be doing is to be widening the moat, really. So I guess it's sort of that kind of idea, isn't it?
Exactly. You take the energy business there, that they have enormous advantages, sort of mini monopolies, and they've got enormous economies of scale. And they also have some technical expertise, some licenses, some regulatory licenses, that they've got a lot of power, of strength. But at the same time, they also know that world is changing in very in potentially surprising directions. And so the forms of energy are changing, and what's acceptable is changing. The reliability of wind and solar, geothermal, and so. But what they're doing, what Greg Abel is doing at the energy business, is building moats by developing new tools, new technologies. Being a leader in the industry, being a leader in the political aspects of this. And so that's what he's doing every day, is trying to build, widen the moat, being mindful that the existing moat may be under attack.
Yeah.
So it's shrinking, but he's got to thicken it elsewhere for the overall business. And so that's what he's doing every day. I think at the other end of that company, you see See's Chocolates, See's Candies.
Yeah.
They're protecting their existing moat is a distinctive brand with loyal customers and a certain look and feel and presence that's very special in their eyes. But that's people can be finicky in the chocolate business. It's ultimately it's really about a fundamental part is about features other than that elegant old-fashioned lady and the emotional association. So what they're trying to, while preserving what's special about that brand, they're trying to be to new distribution systems, trying online, airports, places beyond their typical. They've opened up stores in New York and Miami, and so you've got to do it. You can't just stand, rest on your laurels. That, oh, well, we've been in business 100 years and everyone loves the little old lady candy.
Yeah.
So, but you can't go the other way. What Brad Kinsler, prior CEO, always said was, I don't want to be sold like, Stovar's candy in every drugstore in the country. That's not going to help my brand. I don't want to be Russell Stovar, I guess it is. I don't want to be a simple can. I'm going to be a special, high end, rare, and hard to find. Well, that worked, but but it's not forever. So how do you do that? So you're right. Warren's got his troops thinking moats every minute of every day, and if you measure, See's moat, it was strong, then it was under attack, but I think they're thickening it, and I think it's in the right direction, but you got to monitor it all the time.
How would you? No, that's really interesting. How would you define? I know there's in the sort of introduction there's there's three characteristics that indicate quality. So cash generation, returns on capital, and growth opportunities. But I guess usually what we hear is the sort of is value versus growth, and quality is a sort of slightly different dimension. Could you help? How do you think about this? I guess growth is an element. Most of these quality companies, have an element of meaningful growth to them. But to what extent is there overlap between sort of value growth on the one hand and quality on the other?
Yeah, it's sort of like a Venn diagram, isn't it? That value and growth mean different things in a lot of contexts and for a lot of people. Yeah. But in plenty of contexts, they overlap. That growth, Warren almost denies that there's a difference, saying if you're trying to figure out the value of something, it's simply the present value of the discounted cash flows. And when you calculate those, you're going to be thinking, what's the growth rate? So, and obviously you're going to have a higher value, the higher the growth rate. But that, that's a kind of a purist version of it. I think other people think about value investing as insisting on a maximally thick margin of safety, a deep discount between the price you're paying and the value you're getting. And growth is more. I'm not hunting for those bargains. I'm hunting for the big payday. The 10 baggers or something, next year, the one after. And I think the quality investing Venn diagram is kind of, well, the mindset is still hunting for value and being fundamental in orientation and trying to identify in a conservative way the value you have. But a little bit of the growth part is being willing to pay up when you've got a a quality business that is one with a durable competitive advantage, that reliably determined. You don't need to be certainly not a Ben Graham or even a Warren Buffett. You can pay up, so I think that's kind of how I think about it. Is a quality investing is really a hybrid, if you want, of growth and value, or takes Warren's insight at its most practical level. That it's actually the same style or philosophy, but the key thing is disciplined analysis, and then a willingness to put your money where your mouth is, and say this. This is Unilever, this is Diageo, this is Cohn. This business will generate excess cash, high returns on invested capital, and find new ways to deploy it. And I'm going to buy it at a fair price, and with the intention of holding it really, and until a clearly superior opportunity arises, or until the moat really starts to turn.
It seems to me that, in a way, quality businesses are never, they're never really out of favor, and they're never really in favor, in the sense that, when there's these turns in the market, that they'll never do as poorly as the low quality businesses on the way down. They'll never do as well as the sort of fast growing or cyclical stuff on the way up. So, I mean, I don't know if do you have any thoughts around that? It just seems like they're sort of, I know it's the tired expression, hiding in plain sight, but to me, it seems like there's an element of that. They're not the fastest growing, but, if I look at the case studies in the book, these would be maybe sort of 4 to 8 or 4 to 10% organic growth businesses, bit of margin expansion, sort of low to mid-teens EPS growth in many cases, but over time that just sort of really delivers tremendous returns. Do you agree with that sort of description, or or are there times when these businesses really sort of shoot the lights out?
I think your general orientation is right, that the quality investing framework we describe is a long-term orientation, and so the goal is steady, sustained earnings, return on invested capital that compounds, so that wealth just accumulates as years go by, and it's not trying to look for and look, Amazon is a really interesting example. So I was going to say that took a long time. That was a quality company, but it took a really long time to prove that, and then an even longer time to realize the value that was there. But someone who bought that stock, in 2000 or 2004, they would have had to hold it through a lot of thick and thin, and a lot of thin earnings, but boy, so I would say that as he built it, as they made it clear that they knew how to dominate a sector, dominate an industry, and they put all the bookstores, more or less out of business, and then they moved along to lots of other segments to do publishing itself, with Kindle, and then pioneering in so many other applications now. Yeah. So, but it took a long time. It wasn't, whereas like say, Tesla, it's a little harder to see. I mean, he's been at it a long time too, but the real pop, has been lately, and it's a little more speculative there. And so I wouldn't be comfortable necessarily calling it a quality company at the moment. There's just too many uncertainties and moving parts. So I think the general sense is that flash is not what the quality analyst is really looking for. It's looking for that record of sustained, repeated return through thick and thin. And so you're right. Well, I think the data you mentioned about the case studies, and even just if you reeled off some of the names, these are venerable titans for the most part. And that is I think the pond with the bigger fish in it for the quality cohort. The other aspect of that is, some of the features can be intangibles, and intangible features are often fleeting, and so what works in one period might fail the next. So having repeated different environments to test the strength of a culture and its adaptability as the world changes, is helpful to obtain the assurance of the durability of the business. And you take take Unilever. I mean, they go through lots of different cycles, economic cycles, geographic changes, conflicts, product, um, consumers embracing the product, consumers doubting the product, and being nimble enough to navigate all that through all that adversity and maintain overall the solid economic performance, sometimes stronger, sometimes weaker, but to, as you say, be able, you're not shooting the lights out, but nor are you shooting yourself in the foot a lot. So
Yeah.
I think you're right about that. There is a certain, but this doesn't necessarily narrow it down. There are thousands of companies that are potentially in this universe.
So can I just ask you about in your view, what sort of enables these quality companies to outperform? I guess, in principle, that quality should be reflected in valuations. But then if I look at it, to me, it looks like there's all these institutional factors, such as time horizons, this belief in mean reversion, maybe partly accounting rules and how they treat sort of investments in non-tangible assets, if you will, etc. Do you have a list of things that in your view sort of explain sorry, the sort of why these companies, why their valuations don't fully reflect the quality of the businesses?
Well, yeah, the sort of hidden assets or hidden value is the category, and you've identified three nice ones. And there, for a long time, ownership of real estate had been underappreciated, mainly because accounting rules, I guess, and also sometimes it simply wasn't deployed in the optimal way. And so you had restaurants or movie theaters, businesses that owned a lot of real estate, but had been valued based on, food sales or ticket box office. And in fact, that they were worth a lot more if you counted the real estate. And people unlocked that value doing sale leaseback transactions and other techniques to monetize that hidden value. And I think, that's probably the broad category, and it probably that's the general pattern. And so if you can you find that that asset that's not a GAAP asset, it's not an accounting asset, and you're trying to figure out, well, why are there superior returns on invested capital here? What's going on? And I think that so accounting conventions generally can obscure that economic reality. You mentioned the whole category of intangible assets. I mean, I think that's really the big one. And obviously, some of them are more obvious than others, like technology in a software company, or the know-how to write code that is customers embrace, that's mission critical. There's a whole wealth of value that doesn't show up on a balance sheet. And many, I think many, quite a few of the moats or the advantages that we review wouldn't show up on a balance sheet. And some of them are really important, just like the rationality of your rivals. So oligopolistic industries. There are just three or four rivals. So I say the uniform business. I don't think we give this example, but there's just three or four companies that do employee uniform rentals in the United States. So they've got some pricing power. They've got some brand loyalty. They got recurring revenue because the contracts are usually multi-year. And you can expect that they're not going to. They're going to be responsible competitors. They're not going to try to drive price to zero and drive the industry into the ground, like happens in other industries like soap, detergent. I think we give that example in the book, or beverages. So, and that would be hidden. That doesn't show up on a balance sheet anywhere. It requires the analyst to conduct a little industrial organization study about market share and substitute goods and things like that. And so another one, so interesting one would be, I think you mentioned this, sort of regulatory licenses that, and these can be implicit, explicit, like the accounting firms in the United States, at least. The larger firms are recognized and registered with the PCAOB, and they basically are the only firms that are capable of auditing the vast majority of the largest companies, and so they have a license in effect. They also have moats around reputational value and so on. But that's a very high quality business, the attestation business for auditing. But sometimes a little more hidden, like take bond rating agency. There's not exactly a requirement that issues of bonds be rated, or that a company has to have a rating of its debt capacity, or a university needs a rating for its bonds. But there's a functional requirement. The market, in effect, demands it. And the SEC, the Securities Exchange Commission, in effect, grants licenses to these organizations by saying that designating them as recognized statistical rating agencies, and that has an issuer who gets a rating gets significant advantages, regulatory advantages. And since these two or three are the only ones that have the recognition, that's a license. It's hard to get. It's hard for a rival. It's funny. S&P and Moody's really own that market, but Fitch managed to come in and with some niche focused products. It's managed to get a little share, but not a ton. And so it just goes to show. But then there are other attestation businesses like that where a big part of the economic payoff is that special position. Mm-hmm. It's a barrier. It's hard for a rival to enter. It's hard to imagine an alternative certification mechanism that would kill it. We might eventually get some automated debt rating capabilities that would put the analysts at S&P and Moody's out of business, but I think those firms are front and center enough that they would be able to pivot rapidly from the human judgment to the automated or AI approach. So, but you're absolutely right. So I think there's a list, as you say, of sources of hide. What sorts of things might hide the value, and obviously it's going to come up. That is, you're going to have high sustained returns on invested capital. People are going to want to know, well, how did you do that? And then you hunt for it. If everyone's hunting, it will be discovered, and you'll get high values. But in the meantime, a lot of returns can be generated.
And do you find that these quality companies are, I know the focus of this, I guess in the book, most of the case studies are European companies because of ARCO's sort of focus on Europe, but do you find there's a certain, would they tend to be found in certain sectors or geographies, or even in terms of market caps? And has that shifted? I guess consumer goods 10 years ago, most people would probably have agreed that was a real sort of place to look for quality businesses. And now a lot of people aren't so sure. There seems to be so many sort of threats to them. I mean, do you find that you still find the quality companies in a few sectors and parts of the world, or is it pretty, could you find them anywhere?
I think they, in theory, there is, this sort of business should appear in any sector in any geography at any time in history. I think the reason for our focus in that book, you're exactly right, that Akko's and it's really their circle of competence. And I guess the one that I shared with them is, larger Western companies. So, Europe in particular. And we had a, pretty strong, I guess, if you like, bias. But as we did that, and there, that was the fund that they were running was a European fund, and that's where all the learnings came from, and was really what they wanted to describe. But as we did it, I had kind of a parallel project around what are the 20 U.S. based companies that look like this, and they, you may be right that they congregate in terms of size. I think these tended to be larger companies.
Do you want to share? I mean, you don't have to, of course. Do you want to share any of the names just to get us?
I'd have that list. I'd have to go back and look at it. It's been such a while, but it was, it's funny too that just sitting here thinking about it, it also, these are dynamic companies in the sense that they, in the past 5 years, they've pivoted and done interesting things. United Technologies, I think, was one. 3M,
right,
was one. I think we had Procter and Gamble on there.
Right. I actually spoke to them yesterday. Yeah, that's been an interesting story.
Yeah. So those are the three that came to mind, and I think we might have had Honeywell.
Okay.
And Otis Elevator, I think, obviously.
Well, that's a wonderful business. Yeah.
Yeah. And that, let's see, that I guess that was part of United Technologies, and they also had the air conditioning business. Yeah, and 3M, I think 3M is really, and I think they've continued to manage successfully, and it's a very innovative culture, a lot of engineers, a lot of patents. So they've got, I mean, that's a really nice intangible theirs. They own lots of patents. They've been Scotch tape and Post-it notes and all kinds of stuff. And it's some of those patents expire, but the culture is all about invention, innovation, and the teams of researchers. And one of the great things is in a culture like that is the goal may be to solve a particular problem, but so often in the pursuit you discover solutions that you were not hunting for, and that just has enormous, if you like, hidden value, at a firm like that. So, but I think you're right. So I think that you would find these companies in North America, and I think you'd find them all across Asia. The exact combination of features might change a little in the environment just because of history. Just a technology focused in some Asian markets, a consumer focused maybe in U.S. markets. And going back to my other point about the future, about ownership structures that differ so much in the U.S. It's heavy equity and even a lot of individual ownership and a lot of indexers. In Japanese and Korean markets, there's much more of a cross ownership among industrial and financial institutions. In Europe, you have greater involvement of banks on both the debt and the equity side. And then in some individual countries, you've got a lot of family ownership alongside the equity, the institutions, and especially in Italy, but even in Germany, some very old family companies. And so I think as you're trying to identify what's the advantage at Pirelli or at Alfa Romeo or Porsche, some of it's going to be to do with the regions, the culture where they operate, and that can come about from a lot of different perspectives. So I think our book, if we wrote the same book about Asia or the U.S., I do think some of the content, some of the flavor of of the companies and how they sustain an advantage would be different.
So one of my frustrations, if you will, is that when I look for quality businesses, I end up mainly in large or mega cap businesses, because it seems to me that almost by definition, if they're great business, if they've proven themselves to be great businesses, they're already of a certain size, etc. I mean, do you agree with that, or do you think is it possible to identify, small cap quality well, I'm sure it's possible, but do you think that's a viable sort of strategy, or is that just much harder finding these quality businesses when they're small?
No, you absolutely can. I mean, I think some that I've stumbled on recently. Here in the U.S., Amphenol, which does electronics and sensors and switchers, they've been around a long time. They are number 3 in many of their markets, or number 2. These are oligopolistic markets, require a lot of science, a lot of engineering, a lot of intangibles, and they do very well. And it's not, and they do well in a lot of the things, in terms of the moats, the durability, the longevity. They've been around at least 80 years, 60 years, or something like that. Right. But they're still moderate. I forget the exact market cap, but modest overall. Another one I mentioned, that uniform rental industry. It's a company called, I think it's called Una First. Mm-hmm. First Una. It's one of 3, and market cap, it's relatively small. I don't have the figures off the top of my head. Yeah, I think you can. There are some companies that because they're focused on a particular niche, and that market is only so big, and it's not going to, you're not going to sell hundreds of billions of dollars, so it and it might grow a little, but it's not, you're not turning into a giant. So mm-hmm. I do think, and it might just be that you're better off hunting in that smaller space, because there, the armies of private equity and analysts and big money is not as focused. So you might find some opportunities. Moreover, it might be easier to get a chance to speak with the CEO and really get a measure of the jib, to see if they really seem what they are, and if they turn, in person, confirm your external view that they are something special. Mm-hmm. Yeah, and I'm doing a lot of work on that right now. I mean, you mentioned the Quality Shareholders Initiative. The way I'm finding these companies that could be in a quality investing book for the U.S. is I'm looking at their ownership, and I'm seeing a lot of medium or small, even smaller businesses that fit this model, and I'm stumbling upon them or reaching them because of their ownership. That the Howard Marks and Monishes of the world have noticed it. Here's a great company. And it's still, and a lot of them are even still reasonably priced, so that I would call them quality opportunities. There are a bunch of them. I'm still doing the work, so I can't, but I've dribbled them out occasionally. I write a column in Market Watch, and every once in a while I'll mention a few of this sort.
Mm-hmm. And I know we're I just have sort of 2 final questions for you. I guess one, just briefly on this idea of downside protection, which I just wanted to hear if you have any thoughts on how that sort of ties into quality investing. It seems to me that a lot of the qualities in these quality businesses are really about sort of reducing the downside. But I mean, is that an important element of it, or is it no different from any other sort of discipline or school of investing?
Yeah, I think that downside capture is a rationale for a focus of this sort, and obviously it becomes critical during a um, economic downturn or market reversal. And while we haven't seen that on scale in 12 or 13 years, and it hadn't been 7 before that, they do happen. And so being prepared for it is not a bad idea. And I do think this sort of analysis and this philosophy, this approach, offers a great advantage in that setting. And because it also is a perfectly prosperous one during expansionary periods, it seems like a very practical and sensible approach to me. One that, as they always like to say, that you don't stay up all night worrying about things. You're not worried about Dogecoin, nose diving, or this SPAC finding a partner. You're counting on soap being sold in Indonesia.
Indeed. And do you have any sort of examples you'd like to mention of quality investors today? I guess some of them I love people like Tom Russo or Tom Gaynor in the US. I guess in the UK we have people like Nick Train and Terry Smith. But do you have any other ones that you'd like to highlight that are good sort of ambassadors of this school?
Yeah, I think in the UK, I'd nominate Bailey Gifford,
Right.
based in Scotland. I think they're a pretty sizable firm with a diverse mix, but very focused on quality, very long term, engaged. Some might say they're too long term. They have sometimes said we're just going to hold forever.
Yeah.
And some other funds prefer a little sell discipline on there, but Bailey Gifford, I think it's an excellent firm, and Fundsmith, I think, is an excellent example too. In the U.S., I admire Brandis Investment Partners out from San Diego.
Right.
Excellent firm. There's a couple others I really I've been involved with, who I admire them even at a closer proximity. Epic, it's spelled EPOCH, but I think they spell it Epic.
I saw that. Yeah, I saw that a very interesting paper on the PE ratio from them.
Yeah, that's right.
Yeah.
That's a very smart group. It's a subsidiary of TD Ameritrade. I think the Canadian bank, they bought it about 20 years ago. The firm's much older.
Mm-hmm.
And the other one is WCM out of Laguna Beach,
Right.
south of LA. Phil Black is the one of the head guys. There's a lot of great people, and very, very. They could have. They love the quality investing book. Let's put it that way, and they do deep dives around these sorts of things, and they've grown rapidly. They've just been phenomenally successful lately, and those are all big. I think that they're 90 billion now or something like that. But it is funny, a lot of the quality cohort tend to be more the Russo size, sort of 20, 30 billion. And if Epic is 30, when you start to get too big, it's harder to do this. But Bailey Gifford's doing it, WCM's doing it, so I think you can, but I think you get more institutional pressure that kind of reverts to the mean, and you get closet indexing. But so far, the firms we've mentioned have grown and stuck to their knitting. So I think and then you got Capital Research. I mean, they're huge, and Wellington, Fidelity has a lot of this. Franklin Funds. So it can be done.
No, that's a wonderful list. Just finally, can we anticipate any sort of extension of this work? Will there be another quality investing book based on sort of the U.S. market as you touched on, or will there be an update to the sort of ACO one or any other variation?
My wife always jokes, I can't stop writing and analyzing, and so I've got quite a few research nodes underway and in progress that will result in a book, and probably some articles on the way, including of the sort that you just described. So I don't know exactly what the shape will be, but the answer is absolutely yes.
That's great. I'm pleased to hear that. I look forward very much to that.
Well, that's perfect. I thank you very much.
Super. No, I'm thankful. Thank you so much again. Great to speak to you. All the best now.
Cheers. Have a great day.
Thank you for listening to Investing by the Books, a podcast by Redeye. You can follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve the podcast, we really appreciate your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. For the editing of this podcast, we thank Jon Hintze, and for the graphic design, Jesper Viking. I'm your host, Eddie Palmgren, and until next time, I sincerely wish you the best of luck on your journey through life and investing.